All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. We're going to talk about building a position, and this is a topic that has a lot of implications and is something that most traders, investors end up doing. There are the traders and investors, and even myself, who from time to time I want to be in at the bottom, I want to be out at the top, I want to be puts at the top, and really just trying to trade more than build a position. But building a position is something that you do based on fundamentals, that you do based on some of the longer term outlook. And it's a very much a fund manager strategy. Very much, if you're managing your own, retirement savings or something like that, then you've got a nest egg, and it's not just let's go trade short-term options. You're building a position, and from time to time in the market, there are times to build a position, and I want to go back to one period in time that will always stick with me because of how important it was to my own career. But this is 2010, and my brother and I were fund managing, we're doing our stuff, and we had a great first quarter. And we had a lot of new money flow into the fund in March. And it really took the fund to another level. And that was a little, okay, wow, all right, great, sure, right? You're not supposed to have emotions as a fund manager. Everything's supposed to be analytic, right? But okay, yeah, there are some strong emotions involved. All right, so here we go, right? And we didn't end the month of March on much of a high note. We had picked the bottom right back here on this reversal and these gaps up, and they didn't pay off right away, but they really started to pay off, and we were long and strong through the end of February and March, and really had some great gains to kick off the year. And we start getting in, end of March, not all that great. Okay, fine. Still the quarter ended very nicely. And then came April. And we start looking at our numbers. We start looking at what's going on out there. And the pressure with a lot of the new money coming in was, hey, you know what? Let's get in. Come on. It's supposed to be instant. It's supposed to be right away. Come on, let's go. And that pressure was there not because of anything that we said or did, but because of just the performance and what some of the people who brought other people into the fund had been saying. And okay, great, we deal with it. But our numbers were telling us, hey, there's danger ahead. There's severe danger ahead. But we weren't exactly sure how to position and how to play it. And, the market would go up. The market would just still have these upward days. And then it would have this they had this big drop down right here. We said, okay, you know what? We're bearish. Let's go. And we put on a bunch of bearish positions only to see the market rally the next 2 days and go, oh, man, okay, this stinks. And then see the market pop into a new high. And, I remember vividly an email on this day saying, hey, I got into this fund and blah, blah, blah. Now we're short. Market just keeps going up. Why aren't we long? And, there's always stuff like that, right? But it really kind of gets you questioning what you're doing, questioning what you're thinking about. And, we ended up holding our short positions. We had this big down day right here, and we added to our short positions. But the approach that we took here was a building approach. We didn't go in and say, hey, you know what? I'm going to put everything on the fact that the market has turned today, and the market's just going to go down, and all right, everything's down from here on, and go. This was a building process. And it was one that the building process ended, that building process meant losses. And most building processes do. And ultimately, we had the flash crash day, which we weren't holding all of our shorts then. In fact, you've heard me say it before. The market was down pretty sizably that morning, and we took off all our short exposure ahead of the flash crash. And we actually got a little bit of long exposure, which was, that was fun. But overall, our building paid off, and paid off in a really big way. But in the short run, it really stunk. In the short run, it really just, the chop, the up, you turn on the TV, the market's hitting a new high, you're betting short, and oh man, you're going to look stupid if you're wrong. There's all that kind of natural emotion type of stuff. I've built positions in my career where it's going against the market. Where I've built positions to the long side as things have been going down, where I've built things to the short side as things have been going up. And sometimes they didn't pay off, and sometimes they did. But whenever I build a position, there's something that I have to keep in mind. I have to keep in mind, how much am I willing to risk? How much am I willing to risk on this position build? What percentage am I willing to risk? If you're in a retirement account, you're doing it with something, okay, whether it's an individual stock, if you're doing it with short-term options, long-term options, you always have to define to yourself. This can't be is the market going? Is the market moving? When do I add more? It can't be all those questions, because those questions will be maddening. You have to define in yourself, how much am I willing to risk on my thesis? Now, in building, how much can I deal with? How much can I, how committed can I stay? If we had built too much right here, what would have happened? Well, as the market went to a new high, would we be able to stay in? Would we be able to stay committed? It looks easy in hindsight because you see that, hey, things go down. But this day was gut-wrenching. But the reason we're able to stay in is simply because we hadn't built too much at that time. Had we built too much at that time, we would have had to be out. We would have had to take our loss and move on. Well, great, fine, that happens. And so when we go out and you build a position, you have to look at it in stages. And I look at it in 3 stages. I look at it as stage 1, the toe dip stage. I'm just putting a little bit in to start to get involved. Just to start to get involved. I don't have any real stop. I don't have any real price target. I don't have any real risk parameter here. I know, yes, it could do something crazy, but I haven't put enough in it that it's going to affect things to a dramatic degree. And you know what? If I'm right and I'm right away, I can sit back and say, well, I should have done more. Right? That the hindsight's always there. And we did that right here. Stage 1. Stage 2 is, okay, now I'm willing to commit. Now I'm willing to commit enough and define what I'm willing to risk. And if I hit that risk element, I've got to go. I've got to leave. That's stage 2. And never want stage 2 to be too tight. Can't be too tight. If it's too tight, you might as well just be instant trading and, figuring out whether the market's going to go up or down in the next 20 minutes, right? Get it, playing those games. So stage 1 is the toe dip. Start to kind of, it's amazing when you have money into something, you watch it to a different degree. Have you ever noticed that? You have stocks on your watch list, but you're not in them. And, okay, you're watching them kind of normally. And then once you're in, it's a different level of watching for most. So you get that different level of watching. Then you get that, okay, we're going to up our exposure. And this is always the area that I want to be right in. I want to be right on stage 2. I want it to go my way on stage 2. I know I'm not fully committed, but I also know that it'll pay off enough that I'm okay and go. That's always where I want it to. Now, does it always do it? No. And then there's stage 3. Stage 3 is the area where you step in and you add the rest of what you're willing to risk. And you have to draw a line in the sand. Now, if you're trading short-term options, that line in the sand could be 0. It could just be your exposure, right? If you're trading stock or you're trading short stock or something like that, or a fund, you got to put different lines in the sand. And on stage 3, you have to do that. And one of the things that we did right here was we got into a lot of stage 3 on this day. Now, it wasn't our full stage 3. We got in these 2 days is where we really built. And then the next day it went on up, right? Went on up. Oh, here we go. We finally build, and then it goes on up. And then we get the next day down, and the next day up, and the next day down, right? It can be kind of wild, but you have to stick with what your tolerance is. If you start to go and look at the days and go, well, this one's up. Did that change it? This one's down. Does that change it? That starts to get into a game of chop that tends not to mean a heck of a whole lot. And so these 3 stages of building, the dip your toe in, the okay, I'm getting a real commitment here, and okay, I'm in, let's go stage. And you have to define for yourself what you want to see in order for those to happen. You'll notice on these stages, our dip the toe stage was an overbought stage. This was just, hey, the only real argument out there is overbought. Our okay, we're committing was that first dip below the 7-day moving average, right? And then hey, we're really committing, our third stage was that next dip below the 7-day moving average. For me, a lot of builds, that's what I'll use. I'll use that 7. And so when I look at this market, I want to build. I want to build. And right now, okay, when it comes to the S&P, and let's get today's chart. What's here? Well, what's here is a toe dip stage. It's a simple toe dip stage. That's it. If I'm going to go and start building a downside position, and let's just say the downside position I'm going to build is let's just say it's SPY short stock. Okay. If I want to get in now, it's just toe dip. That's all I have. Just the toe dip stage. I have to put what I'm willing to lose. I have to I can't really look at any hard levels and say that it means a whole lot. It's just a toe dip stage. The next dip below the 7-day moving average, that goes stage 2. Hey, that's where I commit. That's where I say, all right, let's go. Now, I don't have to. I could back out of the toe dip stage. I can say, you know what, I really don't want to build this. I can change my mind anytime. But that first dip below the 7, that's the commit. And hopefully it really starts to work right then. But then I leave myself a third category here of, all right, I'm all in. I'm committed here, and I put my line in the sand. So however that plays out, here with that. Okay? And so I'm going to do something today. I'm going to go out and I'm going to pretend here that, I'm just going to allocate $10,000 to a SPY short position. Okay? And just using stock, not options. And I'm going to go and allocate it here and build a position. Okay? And so if I'm willing to commit $10,000 to this, right, what's my ultimate loss? Well, I don't have to decide that yet. Right? I don't have to decide that. I'm just in the toe dip stage. Okay, so I'm going to go out and I'm going to commit $4,000 here. You say, well, that's 40% in the toe dip stage. And you're right. It is 40% in the toe dip stage. But I also haven't defined my loss or anything like that. And I know, okay, you know what? With this position, I'm willing to take about a $1,500 loss, somewhere in that area, right? And so to lose $1,500 on a SPY short position, I mean, the market's going to have to come all the way up to here. So I can put a little bit more because I'm dealing with stock. So I'll commit $4,000 to a toe dip position and go from there. And now I say to myself, all right, Jeff, next time on the commit stage, when we dip below the 7-day moving average, I'll add the other $4,000. That's going to be my plan. And on the all-in stage, I'll add the other $2,000 and define my exit. Right? I'll define, let me get a better D here. I'll define my exit. So I'll know exactly what my risk is at that point. And some will say, well, Jeff, this isn't exacting. This isn't, you don't know exactly right before and the different levels and have this pivot. No, I don't. Absolutely don't. But I have a hunch. I have a suspicion. I don't know if I'm right. I want it to pay off if I'm right. And I don't want to have to figure out, well, is today the day to go all in? I don't want to have to sit in stage 3 all the time. Oh, okay, I have nothing to the downside. Okay, now I got to commit it all today. Oh, man. Because what's going to happen, the first big down day, you're going to go, well, do I want to go and commit all $10,000 into it on the first down day? It's a lot easier to commit an additional $2,000 on that down day when you already have a nice position. And so this is how I go about it. And I do this with stock. I've done this with Alibaba for the last year. And I go through these different stages. I've done it with IBM. It's not as applicable to the challenge, to the 100K challenge. This isn't something that I look and I go, well, you know what, I absolutely have, can do this for the challenge. In fact, for the challenge, it's a little bit more of stage 2 to start, right? And then maybe stage 3, that toe dip stage, not really valid, until the challenge is in a different dollar level. But down here in the 2, 3, 4,000, even 5,000 to 10,000 area, it's just not very applicable. Okay, so this is kind of for building those types of positions to play a hunch. In terms of the SPY and me personally, I'll go into the toe dip stage here today. Now I've already toe dipped a little bit on a stock and on something, and that is AMD. And, I've talked about, hey, I want to get short it, and I've talked about the fact that there hasn't been confirmation. But this week, I just couldn't help myself, and I went to the toe dip stage. Okay, got my toe in, watching a little bit differently, but I haven't had any confirmation to get into that second stage yet. And I may not, right? I may not. But when I do, I'll be able to take advantage of that and go. And that is something when it comes to a lot of trading, building positions can be a lot lower stress type of way to trade, a lot lower stress type of way to look at a trade, as long as you can get rid of the hindsight. Because if this week AMD would have flushed, I put my toe dip position on, and I wake up and AMD's at $19. I will have made money, but how will that feel? Oh man, I should have done a full position. That was stupid. Blah, blah. Right? There's always a way to play the hindsight game and to crush yourself psychologically, to absolutely, totally annihilate yourself psychologically. But in terms of the reality, well, one of the reasons is to have the toe dip stage is in case, something like that happens. Is it the norm? No, but hey, just in case there. Okay. So anyway, that's that's kind of building a position, going about building a position. As before I kind of took a week off, I got my upside exposure in the market down, and it's one of the lowest that it's been in many years. Right, and eventually I'm gonna have to start building positions again. It's not like I'm going to wake up one day and go, oh, hey, the market's bullish. Let's go and buy all this and go all in and get back that exposure. No. It'll be about building positions. It'll be about, hey, okay, you know what? Where do I go and build? One position I would like to build is back into Alibaba, right? I haven't done it yet. Right? Haven't done it yet. I still think it's got some downside. So I'm not even tempted to start a toe dip position here because this is something where, you know what, if it's at 150 or 145 or 140, that's where I'm going to want to toe dip. Right? So I'm not even interested in doing any kind of toe dip, right here with it. I do have some AT&T, right? I have some AT&T. We've talked about this for a while, and I've gone through the various stages here with it, and we'll continue to do so. But as I start to look, and we talked earlier today about Oceaneering, right? I don't have a position on Oceaneering, but how do I start to go about it? I could toe dip here today. Right, I could toe dip here today, but I like to toe dip on some pullbacks. That's my general nature. But sometimes I'll chase them a little bit, and that's how I would go about. If I'm going to start a position here with Oceaneering, I'm going to start building it today with a little bit of a toe dip. One that, hey, if I wake up tomorrow and Oceaneering's down $1, I'm not freaking out and going, oh my goodness, is everything, did something change? Is something going, where it's going to affect things in a huge way. Right? And so basically I'll dip a toe, start to watch it, start to be able to kind of mold an idea of where I'd be willing to add more or where I'd be, needing to pull off or anything of that, anything of that nature here. Okay. So hopefully that helps as far as building a position and the 3 stages to kind of look at. You can look at it with more stages, and kind of stretch it out a little bit, in terms of percentages if you'd like. But I find 3 stages generally, works and, generally gets the job done. One stock, I've talked about AMD, but one stock that I'm regretting not building, starting a toe dip position into this week is FedEx, right? But you can kind of see FedEx has had the first shot below the 7, now the second shot below the 7, and this is a stock I'm very strongly bearish on. I think has a very sizable downside. But I've been trying to time it up rather than build a position. So the chances of me getting left in the lurch are a lot greater than what they would be typically. All right, about 45 minutes left to go in the market here today. We are looking at a market that is, well, here we go. The S&P pretty much where it opened up at. And we've had that pretty much, every day this week except for Tuesday, where we did have about a 13-point move from the open to the close price. Excuse me. My apologies, but we had about a 13-point move there. But every day it's pretty much opened where it's closed, and we're looking at that here, today coming into play. And is there anything that different? No, the metrics are still the same. The metrics are still in control. The bullish control here. We are getting a ways away from the 7-day moving average, a little far away from that relative to kind of historical norms, to where to see at least a snapback to the 7 would not be too uncommon there to see. But overall, there's when we look at the aggregate here on the week, there's no kind of bullish control. Bearish control, any type of the bears wrestling things away, here from the bulls. Me personally, when it comes to challenge trades and overall, I think there's some strong selling that's coming. And that's my suspicion, and I can talk about, I've talked about why a little bit. I can talk about that more as we go forward. But while yes, I have a strong suspicion of selling, I can't for the challenge get more aggressive than where I am, and I've basically been willing to say, hey, you know what, I'm willing to lose about 1,000, here on the XLY. So I'm going to hold it into the weekend. And, if it gaps down, if we see the market gap down on Monday, I do think, or Tuesday, we will see some strong selling come in. But, it is something where at least a pullback to the 7, and I could kind of see where to go from there. All right, but to add more downside, I just can't do it here just yet, and to run with that here, just yet overall. All right. Remember, Monday markets are closed for the holiday, and so we'll be back here on Tuesday.